Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Aileen Prak. She is a real estate investor, a co-founder of Bonavest Capital, and her focus is on investing in multifamily syndications, both actively and passively across different markets in the U.S. Aileen is also the co-host of a weekday podcast, How Did They Do It? Where she has interviewed over 700 real estate experts. Aileen, welcome to the show.
Thanks for having me, Keith. It's nice to be here.
Yeah, appreciate it. And maybe if it's okay with you, we can maybe just start with a little bit of your background, where you grew up and eventually what led you to real estate and real estate investing.
Sure. So I grew up and was born and raised in Southern California. And, I come from a family where my parents immigrated to the United States after they had overcome and went through a war-stricken country, genocide and things like that. So they really started here in the country with nothing really, no connections, no understanding of the English language. So they came to this country and built themselves up from the ground up. And so as a kid, my parents always instilled in me, make sure you get a solid foundation, get a good education, because essentially if everything is taken away from you, because that's what they learned, everything was taken away from them.
Sure.
What they cannot take away from you is your education and what's in your brain. And so if you have that solid foundation, if you build something for yourself, you can always, even if everything is taken away from you, you can always start again from scratch. And so using that as my foundation, my sounding board, I always wanted to, in a sense, because they had given up so much for me and they sacrificed so much to come here to the country, try to provide for me a better life, it was always in my wishes to try to do my best for them, also repay them and kind of make them proud in a sense and show them that, hey, you came to this country, you gave me such a great foundation and a sounding board to, be successful in my future endeavors and things like that. So I want to make you proud also. So I went to school, got good grades, went off to get a good job within a corporate in aerospace finance. I'm in management now. And so that whole thing, I went to go get my MBA because it was all about, building up that foundation, showing my parents and my family that, hey, you came to this country with nothing. And look how, with your help and like what you've set for us, we've been able to come this far. And so that's really where I started from after going to school and getting my MBA and working in finance for a couple of years. I started, me and my husband got married, and then eventually we got pregnant and had our first son. And so that really kind of changed our mindset a little bit about how we thought about money and what we wanted to do with our future careers. And it just changed our perspective a little bit.
Yeah, I think that's a great perspective. First of all, what you've done, coming to, I can't stress enough how much that's made a difference. Also in my own life, is just investing in my education, whether it be outside of school or whatever. It just makes a huge, huge difference. And you're right, people can't take that piece of the puzzle away. So that's great. What country did your parents come from, if you don't mind me asking?
From Cambodia.
Cambodia. Okay, I've gone to Cambodia on vacation. Actually, it was a great trip. It was one of my favorite countries. We went to Singapore, then Cambodia, then we went to Vietnam, and then Thailand, and then back to Singapore. But Cambodia, out of all those, believe it or not, was one of my was one of my favorites. Obviously, not the history of the genocide and all that good stuff, but just the country itself, the people were really really good. So anyway,
That's awesome.
yeah. So yeah, and then what led you to you? So you're you graduate and get your MBA and you start in aerospace. What you were working? You mind talking about what company you were working for and all that?
So it's just the aerospace industry, moving around from different companies, and just eventually, how I got started was really just building myself up and just working and just thinking that was the only way to really walk this path and to make that income was to work a corporate job and contribute to your 401k and things like that.
Yeah, yeah. That's our audience here is really, busy professionals who, they've done their 401k, that kind of thing, but don't necessarily have the real estate side of it. Because most people, when they think of real estate, they don't necessarily think passive is even an option when it comes to that. So what bridged you to, I know, having the child and, kind of helped change your perspective a little bit, but what eventually led you to real estate, and then where did you start when it came to real estate?
Yes. So like I mentioned earlier, after having my son, you really understood the importance of time and how fleeting it is. And so
Hmm.
wanting to take more ownership of your time and also remove some of that reliance from that W 2 income. Because what we always think about as we, start working for a job, a corporate for another company, is that, that is we consider a safety net, right? Because you're getting that paycheck every 2 weeks, and it's always coming in the mailbox, but you're trading your time for money. But at the same time, you're heavily reliant on it, and things can change within the company that's outside of your control. And what we wanted to do was really take ourselves off the reliance of it and start looking for different ways to create that passive income for ourselves so that we can choose to continue working in our W 2 jobs, not necessarily because we have to now.
Yeah.
So that really kind of solidified our path in wanting to find different streams of passive incomes for ourselves. We were working a W 2 job, young, we just became parents of a newborn. And so
Hmm.
our time was really hard. It was really hard to find some time to do a lot of active work at that time because we are trying to figure out things on our own, figure out with the kid. And so we wanted to be we wanted something to be a little bit more hands off, a little bit more passive, work with a property manager or something like that. And for us looking at real estate, we always knew it was a great wealth building avenue.
Hmm.
It was a place, that you can create that cash flow, but at the same time, you can also gain some of that appreciation throughout over the years. If you hold it for long enough, there's that opportunity there too that you don't typically see in other investment vehicles. And then you also get a bunch of tax benefits. And so for us, that really fit our lifestyle and what we were trying to achieve. So we started off with single family and did some couple investments outside of California. But it changed when we found multifamily syndications, which is really just investing as a group together to buy larger apartment buildings. And then we realized that that was a way that we really enjoyed it and became more passive because now instead of you operating a single family home, working with the property managers directly, now you have an operating team who handles all of that. And we remove ourselves from the landlording activities and just really do our due diligence on the deal, do our due diligence on the sponsorship team, and then invest passively and then wait for that, what we like to call mailbox money to come in.
Yeah, exactly. So, as far as the single family, to maybe go into that just a little bit, where outside of California did you invest? And, before you made the switch to multifamily, what did your portfolio look like?
Yeah, so we went to St. Louis, and it was um originally we were looking in California, to be honest, because that's what we knew was
Yeah,
invest in your backyard, be able to drive to it, see it, touch it, feel it. But as we were looking at it and we were trying to find the different opportunities, one, we kept getting outbid on different properties. And then two, the cash flow wasn't there, wasn't aligned to what we were trying to do.
yeah,
It's a very highly appreciated market. You're not really making a lot of cash flow, but it's a very high appreciating market. So for us, we found through all of this that we are more of a cash flow investor we like to see the opportunity and potential for some upside later on, but we like to see cash flow first. And so that's why we decided to go into a market that was strong in cash flow to kind of get our feet a little bit wet in the space, understand how the ins and outs works, working with a property management team, and then see where it would take us from there.
yeah. That's great. And I think if you're looking at you mentioned earlier about being not so reliant on the W-2, and I agree. I think the financing piece or the cash flow piece is important, right? So investing for cash flow where you ultimately can be job optional at some point uh, through your investments. But you really can't do that if you're just waiting around for the appreciation. Appreciation is nice, and it's nice to get a little bit of both of those. But cash flow is king, at least in my world. And I know other people invest maybe for more appreciation and stuff as well. But yeah, I'm on that cash flow hunt right now. So
Yeah. And I think it depends on everybody's investing journey, and their appetite for a risk is a little bit different and what they're looking to add into their portfolio. So it's just you got to diversify and look at what's important to you. At this particular stage in your life, is the appreciation. Are you able to handle the risk and absorb that? Maybe if you're younger, you have a lot more time on your hand. You can a lot more time in your future to kind of absorb any potential risks or downsides of that. You kind of you weigh and outweigh the different risks out there. And then
sure.
if that's something that you can do, appreciation is a fantastic way to build your wealth quickly. But if you're later on in your life, you're maybe towards your retirement age, you need to rely on more of that consistent cash flow coming in. Maybe the risk profile is a little bit different than if you were investing as in your 20s.
For sure. And so, in everything that you did, single family wise, was in St. Louis.
Yes.
And how big was your portfolio? You may have said it, and maybe I just missed it. But how big was your portfolio before you made the switch?
Yeah, so we didn't get too big into the single family space before we made that switch. We just ended up with a couple before we found multifamily syndications,
Okay, yeah.
and then from there we invested full time, or we jumped in full force into the syndication space.
Okay. And so as far as that change, what were some of the reasons maybe that you went to multifamily versus single family? Talk a little bit about the motivation there.
Yes. So with the single family, what we found was a single family home, your value of the house itself is based off of the comparables. So if in your neighborhood, your neighbor has some type of hardship or they were unable to pay their mortgage, they go into foreclosure, their property value significantly drops. That then affects the price of your property there.
Hmm,
And so, one, we didn't like that. That was kind of outside of our control. It was based off of the market and your neighbors, and you couldn't really control the value of it. So that was one thing about single family. And the other thing about it was that if you were renting it out to a tenant and that tenant decides not to pay, or you can't find a tenant to rent your property, you are 100% vacant. So you're not getting any income coming from that. You're not getting any relief on some of the mortgage payments and things like that. So it's going to be falling solely on you. Now it becomes more of a liability instead of an investment property. And so that's what we found as we were doing our single family rentals, was that, during COVID times, people had a bunch of hardships and things like that. So they were unable to pay. When you have turnover costs, when they decide to move out and find another property or place to live in, that also costs money to turn over the property, and there could be significant damages, and that might wipe out your entire cash flow or all the gains that you had made throughout the years or that over the year. And so we found that wasn't necessarily conducive with what we're looking to do, and that we weren't able to scale quickly enough because we did the calculation and we kind of backed into the numbers, and we're like, oh, you have to buy a significant number of single family homes multiple times in order to gain enough passive income to take your reliance off of the W-2 income and, make that comparable returns on your portfolio. And so when we found multifamily syndications, it was very different because now we realized that, one, you can buy bigger properties with other people. So you're now on a team. You're not doing this all on your own.
Mm-hmm.
The other thing is the vacancy level and the occupancy. If you have 1-2 tenants that are not paying or anything like that, you're still able to offset it by all the other units that are occupied. And so that risk is now diversified across multiple units versus just one. And then the other thing is the value of the multifamily property itself was now based off of the income and how you're operating the property. Now it becomes more of a business, and it's not based off of the comparables and the market rate that your neighbors are experiencing. So if you're efficiently operating your property might be worth more than your neighbor's property, which might be the same unit count, same size, and things like that. But if they're not efficient, your property is definitely worth more because now the valuation is based off of how much net operating income you're bringing into the property every month. And so we liked that we were able to control and impact the bottom line through, running the business efficiently, managing and operating the property. And so for us, it made more sense for us to convert and transition over to the multifamily because the scalability were there. You had the efficiencies that you're able to utilize across multiple different unit spaces. The business model made sense to us. And so all of those factors really solidified our decision to get into the syndication space.
Yeah, all really good points. One thing people don't always realize as well is, for if you're doing single family, you're having to apply for, X number of, for every house, X number of loans, and there's a lot of paperwork. You're gonna have to go to those closings. And then, as you said, on single family in particular, you're working. I like to refer to it as a cylinder, like a cylinder in a car. You're only working off of one cylinder, and if that tenant happens to fall on hardship or move out, all of a sudden you're the one floating that mortgage. And as you mentioned, anytime they move out, at the very least, even if you had the most meticulous tenant, you're still going to have it cleaned, and then there's still going to be that loss of time between when it hits the market and when you get it rented, that you just don't see the same impact. Because that's 100% of your income on that particular asset versus a 1/200th or what, depending on the number of units when somebody moves out. So that's neat. So when you went into multifamily, did you go into it? Who did you decide to partner up with when it came to that?
So when we discovered the multifamily space, we started to dive in first. And this all goes back to my foundation of needing to get that educational base first and really understand what you're getting into, and then having this proof of concept. And so when I say we, me and my husband, we really dived into listening to podcasts, reading books, trying to network with as many people as we could to try to understand this model and really figure out, was this what we wanted to do. Is this feasible? Are we really willing to put our trust in an operator that we might have not met before, and then trust that they are able to really care for our capital and, not take it and run away with it?
Right.
And so that was a lot of mindset shift and a different way of thinking about investing and how we wanted to approach growing our portfolio and wealth building. So once we got over that mindset piece of it and started through educating ourselves with the podcast and books and networking and things like that, we found a sponsor who we really aligned with in terms of values, and we liked what they were doing in the space. They had done several deals in the past. So we got to see some of their performance and what they were looking for. And so we built a connection with them for a little while first before we felt comfortable enough with investing first as a limited partner, as a passive investor.
Yeah, that's neat that you had the opportunity to kind of learn a little bit along the way, and it just makes it a lot more comfortable to be able to put that money out there. You mentioned mindset, and I think there is a lot there. A lot of truth with what you said. I think most folks, if they have not invested, even, and quite honestly, even if they have invested, there's always that fear. Is this a operator experienced enough that they're going to be able to do their business plan and make it, execute on their business plan, it probably, for those that maybe haven't invested at all, it may be, are they going to just take my money and run, kind of thing. So what other things did you do to maybe get yourself a little bit more comfortable with the concept and the idea? And then when you did decide to make the leap and go ahead and invest, how much capital did you initially invest?
So the only way to get comfortable is through education and learning about it as much as you can,
Mm-hmm.
because you can talk about it and you can see what other people are doing and things like that also. But until you yourself understand the business model and you get to a certain level of efficiency with understanding, the terminology, how the business model works, how do you get your capital back, how is it backed, and how is it protected, then it makes it a lot more comfortable because now you understand the business model and you understand that, this is a hard asset. If anything happens, your money is tied to this asset, this property, and you can always go back to it. And your money is now, it won't go down to zero essentially because it's still backed by a physical property.
Yeah.
And so for us, that really helped to solidify it. And also when you invest in a syndication, also they send you like a PPM, which is like 60 pages plus of all the risks and downside and all the things that could happen within this investment. And so it tells you up front, every investment is an investment. So there's always that opportunity or that possibility that you could lose your investment. But for us, we had to take that first step and invest first so that we had that proof of concept and that you're able to absorb the loss in case the investment didn't go the way it was planned. So making sure that the money that you invested, if you were to lose it, are you okay with that? Like, would you be able to sustain the potential loss of your investment or not? And
Yeah.
so once we got over that and we looked at our finances and we're like, okay, this makes sense. If we didn't do the first property, or if we didn't make money in the first property, is that okay? Would we be able to absorb it? And when we figured out, yes, let's learn it, let's make sure, and let's have this proof of concept, then let's go ahead and invest. And so that's how we kind of overcame that initial thought.
Yeah, another set of really great points, and I think that's important for anybody who's deciding to invest. You do have to recognize it is an investment, and you don't want to be moving your entire nest egg into something. It needs to just be a small portion. That yes, you could. Will it hurt? Yes, it'll hurt if it goes away, but at least it's not everything that you have. And then even diversifying amongst various, passive investments as well. So you're not betting everything on one specific deal. Maybe tell us a little bit about that first deal that you invested in. How many units? Where was it? If you can remember what on that first one.
Yeah, so that first one, it was a little over 100 units and it was in Colorado Springs. And that one there was a fantastic deal for us to invest in first because it was at the end of 2019, early 2020 is when we put our first investment in there. And then we got to see how the operators sent their communications to us on a monthly basis. We got to see the investment updates. We got to see what they were doing to the property. We got to ask our questions and really learn alongside an experienced operator, a trusted experienced operator in the space. And then from there, it was supposed to be a 5-year hold. The model was a 5-year hold. And actually within 18 months, we were able to exit that deal. And that was a super exciting time for us because that was the first deal that we did and it finally came and went full cycle and we were able to not only make that cash flow but we were able to also enjoy that appreciation at the end of it also. So that was really exciting even though our expectation was 5 years. There's the possibility that if the market was right, the conditions were good, that they could potentially exit earlier, and that's what happened for us.
And so did they exit with the sale of the property on that one?
Yes.
Okay.
Yes.
Yeah, that's neat. Yeah, great time to invest. And yeah, that's probably why the shortage of time there. You didn't need to go the full 5 years and it still made it worth it for everybody. Do you remember on your first one kind of what the multiplier was after 18 months? What did that look like?
Yeah, it ended up being about 1.8 multiple for that
Oh,
deal.
wow. Yeah, that's a short
Yeah.
period of time for those kind of returns. So that's great.
Yes.
Fantastic. And then from there, what other investments did you do? Did you do some more passive before getting? And I know you're
Yes.
active now as well. So
Yes. So our mindset is always, we were continuing to work actively, but we always we always like to invest passively as well. So we work actively so we can invest passively. So we've continued to invest in different syndication with different operators. We invest in our own deals as well as we continue to, become the general partners on some of our own deals. And at this point now, we've done about 14 deals as passive investors across different markets across the United States. And then also, we started getting to the active space as well through different opportunities that come across our way.
okay. And how long ago did you start on the active side where you're partners one of the GPs in the deal, that kind of thing?
Yes. So our first GP deal happened in 2021. And
Okay.
then that was through a relationship that we ended up meeting, a connection that we had formed earlier on through the podcast as well, actually.
Oh, cool.
And so that happened. And that first deal, or actually the second deal that we did, ended up going full cycle since we've been general partners. So that one was exciting as well. So it just kind of organically happened over time as we started networking in the space, building and forming different types of relationships.
Yeah, that's neat. And we can talk in a little bit about, kind of when you're going to be partnering with folks. Obviously, I'm sure they complemented, some of what you were bringing to the table as well. But maybe before we hit that, you've mentioned that you were in 14 different passive investments, which is great, especially for somebody who's now going into, being a GP. I'm sure you've seen things that you were comfortable with as an investor. In other words, you have both perspectives. So from a communication standpoint, is there any takeaways that you have that you really say, hey, I knew from these deals that here's the communication style I liked, here's the frequency, all that good stuff. Any takeaways from any of the passive investing?
Yeah, absolutely. I think because we have that background as a passive investor, we look at things that we like and what we don't like from different operators and how they've communicated with us. And, everybody does things a little bit differently and everybody has a certain threshold on how they want to be communicated to. So for us personally, we really like the monthly communication. Some of the deals that we've been invested in, the distributions are either monthly or quarterly. And that doesn't really matter to us as much as long as we're being communicated to on a consistent basis. We like the monthly communications. I like to see, more details. Some of the different operators that we've invested with, they give like a more of a high level detail of what's going on in the property. And some of them give us a really low level details where they give all the statements and the financial statements and things like that, and that's a lot of information, a lot of good information, so I can always go back and look at that. And so the main thing is that the operators have to have that open transparency and communication and be available for questions. And so if I can email the person or text them and feel comfortable enough to do so, that sets and makes the different operators stand out to me a lot. And it depends on how detailed the answers are also. If they go into high level, like cursory information or cursory details, where you feel like, oh, maybe I'm kind of bothering them or they don't really want to answer my question, it makes me a little bit more hesitant to want to invest in a second deal with them. But if I ask the questions, they go above and beyond and they answer in full details. They follow up and things like that. It gives you a level of comfort, even if the property isn't doing that well, but having that communication and knowing that they are taking care and they're doing what they can and working on that property really sets the people apart. So I would be more willing and more open to investing in a second or third opportunity with them as deals come along. So it's really that openness and that transparency and how often can you communicate with them. And so you find the good communicators versus the maybe not up to your expectations as well.
Yeah.
So that's what we look for.
Yeah, that's great. And I love that as well. I think, just doing it. Well, I mean, if you really think about it, you're putting your money out there and, an expectation of hearing from them 12 times in a year isn't really, anything I think out, just completely out there. So, what about you? So, maybe staying on this just a little bit with 14 different passive investments. What are some of the things that you're looking for in the operator? What are some of the things that you're looking for maybe in the deal?
So the operator is who we evaluate first, right? Before we even look at the deal. That's the main part of it because we have to understand the operating team, what their roles are, who's going to be managing the asset, who else is going to be on the team. So it's understanding and getting that comfort level first, and then making sure that the operator themselves align to what you're trying to do. Their values align, what they're trying to operate and how they're running the business aligns to what you're trying to do, because we kind of look at it like a marriage in a sense. So you want to evaluate them as much as possible, work with them and ask them all the questions up front. And then before you invest with them, because it's going to be stuck, your money is stuck in there for at least 5 years, typically 5 to 7 years in a syndication. And so if you are not getting that comfort level with them initially before you even invest with them, think about like if you're going to be in there for 5-7 years, are you okay with that? And if
Right.
you're not, then it's not the right opportunity. It's not the right sponsor for you. So once you have that understanding of who the sponsor is, what their background is, how capable are they, and are they the right fit to operate that property that you're investing in, then you can look at the deal afterward. And so for us, for the deals itself, we like to look at, especially in today's market, it's really how do we mitigate the risks that are out there? Because with any investment, like we talked about earlier, there's always the potential to lose your money. So how do we mitigate the investments that we put in? So we look at a couple of different things. We look at the reserves that they are placing on the property. Are there sufficient reserves in case there is a downfall, in case there's a cash flow shortfall? Do they have sufficient reserves to cover and to protect themselves in case that happens? I it's hard and challenging when operators go into like a capital call and they go back to the investors and ask for more capital. You want to make sure that they account for all this stuff up front in case there's a downfall, especially like where we're at right now. And then the other thing, especially in today's market, we look for is what kind of debt are they placing onto the property? Is it a long-term debt? Is it short-term? What are the conditions? What are the terms that that they're placing onto the property? Because what we see now is if you're getting floating rates, interest rates can go up and down and things like that. But what are some of the do they have an interest rate cap placed on there? What are some protections do they have in place in terms of like the debt side and keeping the interest rates low and being able to manage to and getting that that projected cash flow that they originally had. And then the other things is the conservatism in their projections. How much rent growth are they projecting on a month-to-month, year-to-year basis? Is that in line with the market? If they are overly optimistic, more so than what the market is saying, that kind of gives me a little bit of a red flag, a little bit of a hesitancy to invest in it, because it's like, well, are you overly optimistic about this? What if the market goes down? Like, are you able to really project and get to that level of rent increase that you had originally projected? So things like that. And then expenses, are they realistic in their expenses? How does that compare to, the previous years? Are they significantly cutting down their expenses? And if they are, how are they going to get to that? So
Right.
it's all about their business plan and the steps that they're going to take in order to meet those projections that they had put in place.
Yeah, and a lot of that, I'm sure you've learned over the years as well, right? As far as what expectations for rent, even with people that have been doing it for a while, it has changed. It has shifted since basically within the last 12 months. Where I don't look for much when it comes to rent appreciation, and if that's what the business plan's built on, it doesn't make a whole lot of sense. I think the point that you made about the the expenses and is it realistic? I mean, there's certain things. We're more in the mobile home space, but billing back water and sewer is like kind of a common. This is a way to eliminate it from the line item, but there can be a little bit of a expectation there that they may not be able to meet if that's not what you've seen in other deals that size. So what about well, let's maybe go from there to before we go there, let's stick with your passive stuff. Where all are they located? And how many of those 14 have gone full cycle?
So we have about three deals that have gone full cycle at this point.
Okay.
And they are across different markets in the United States. So we have some in Las Vegas, Florida, the Carolinas, Colorado, as I mentioned earlier, Texas. So we diversify not only across different sponsors, but across different markets as well.
Okay. Yeah, that makes a lot of sense. And then on the general partnership side, where have some of those been?
So our primary focus has been in the Las Vegas market, but we have some deals also in the Carolinas, and then just looking to continuously underwrite deals in different markets. And but our primary areas has been Las Vegas so far, because it's easy to drive to. We can the 3.5 to 4 hour drive on a good day. So
yeah, that makes sense, and it's a fun place to go to. So cool.
hot also.
Yeah, very hot right now. Yeah, not now.
Yes.
Now. That's right. What about what are you seeing across the board on maybe some of your active stuff? Have people paused some of the distributions, or what's the sense that you're getting out there with some of this? investments?
Yes. So a couple of our passive investments, the operators have paused distributions, and it makes sense for some of them because they're reserving and preserving the capital in
Mhm.
case of more issues down the line. And when that's communicated to us, that's fine. That makes sense. For those that have paused it, but they don't have a solidified action plan to move forward, it makes me a little bit nervous because then you kind of think, well, if the property continues to not operate at the full potential, will they get into a capital call event later down the road? I have a deal right now that, we invested in about almost 18 months at this point, and they still haven't distributed their first distribution.
Oh,
And
wow.
so it's the communication aspect of it. And so kind of like looking at some of those different levers that we were talking about earlier and being more cautious as you're getting into different markets and different opportunities and seeing, do those projections make sense? And especially when we invested back then, the market was a lot different than where it is now. So nobody would really predict that rent increases would, come down this significantly. Interest rates going up this high, but at least none of them have gone to like a capital event. We haven't lost any money and things like that. So we're able to weather the storm a little bit, hold off on the cash flow aspect of it as they're operating and building it up, because we are value add investors too. So we understand that it takes some time to build up that capital, to get the property up and running to a certain level to be able to distribute to their investors. But it's just all about the communication and how often and what's the quality of communication like from the different sponsors.
Yeah, that makes a lot of sense. So none of them you've done so far have done a capital call at this particular point in time.
Knock on wood, no.
Okay. All right. No, that's great.
Yes.
That's great. Fantastic. How about maybe if we could talk a little bit about, kind of your company and what type of investments you're currently looking for and, how people can learn more about you.
Sure. So, like I mentioned, also we are also value add investors. So we look for properties that we can take over from people who no longer want to operate it, who can't operate it as efficiently as we might be able to. And so some of the markets that we look at right now, if we focus on, are in the Las Vegas market. We like the Carolinas also. We're looking to expand into a couple different markets going forward as well. But we look at the different unit mix sizes. So right now we're around the 60 to 100 unit space. But right now the deal flow is a little bit more challenging. You
Mhm.
do have to put in a lot of that conservatism as you're going into the different markets, and different deals, and really evaluating and making sure that the numbers really do make sense, and that you're not just doing a deal just to do a deal. But that's kind of where our or that's where our philosophy is. And we focus a lot on the C, B class types of properties right now.
Mhm.
Potentially going forward, maybe we can graduate into the A class properties later on down the road. But we enjoy the value add space because that's where we've built upon it, and we've been operating the different properties and bringing it up and renovating the different properties and looking at how do we improve operations.
Yeah. Okay. That's neat. And as far as picking your partners, the other GPs, yeah, are these the same? The same people that you've been working with, or what do you look for when you're partnering?
Yeah. So for the partnership, it's especially in the early on stages, you kind of don't really know what you're looking for at that stage, because you're trying to figure out, you know, what do you align with, and what do you want to build your business upon. But as you start getting and you start developing more and more in the business, you start to define and hone in the criteria and what you look for and what you value in partnerships. And so for us, it's become more challenging to find the right types of partners, because not everybody aligns to what you are looking to do in your business, and in terms of their communication style, how they want to operate, how they want to grow. Um, Personalities, they might be really great as just individuals, as friends, but when you get into the business side of things, you kind of understand and you kind of see, the work style, the work ethic might not align to what
Right.
you're used to. And so it takes us quite a bit of time to vet the different people that we are partnering with and building up that relationship before we actually do a deal with another operator. But what we're looking for, is somewhere where we can also add value to the deals too, and to the partnership, that is a strategic partnership, and that it's more of an equal level basis where all the parties have a say in it, that everybody understands their roles and responsibilities. They're operating at a level that we are comfortable with, communication wise too, because not only are we partnering with them, but we're also bringing our investors into this deal as well. And so we want to really vet them as much as we can. And so if we don't feel comfortable investing our own money into that deal, it's a little bit hard for us to want to partner with a sponsor that we don't feel comfortable with investing in. So we evaluate them as a passive investor first, and then if it makes sense, then we'll go ahead and build that relationship. And then eventually, if a good opportunity comes along and the values align, then we're open to that as well.
And what do you think what do you feel like your strong suits are as far as, your role in that partnership? What do you bring to the table?
Yes. So for us, we are in a unique situation that it's me and my husband that are working together in this business. So you don't just get one person, you get both of us, which is nice also because he is focused on, the acquisitions, due diligence side of things. And he's really good at looking at the numbers. And that's where my background is in finance. And so I'm good at Excel, looking at numbers, understanding where some of the risks are, managing within the budgets. And operating the business as well. And so we also bring in, because of our network, we're able to bring in a lot of connections and people, other people who can add value to the deals too if we need to bring it in. So we bring a lot of, not just the acquisition side of things, but we also bring our network and our connections into it. And then our overall work ethic and how we're able to fill in the gaps and what's needed into the different deals. So we're not afraid to jump in as, doing different parts and stepping up when it's needed. And then also doing some of the KP side of things as well.
Okay. And do you have any active deals right now that you're raising for?
No active deals at the moment.
Okay. All right. Have you seen any change over the last maybe month or so in deal flow? I mean, I think there's opportunity. It's just right around the corner, it seems, is the kind of the word I get. But what do you see as far as, deal flow and stuff?
Deal flow is a lot smaller than it was in the past. I think they said that there was like a 60 to 70% reduction in deal flow because people are kind of holding off on it right now and kind of weathering out the storm a little bit. But with that, you just need to be a little bit more diligent in following up on, maybe past deals. We had just closed a deal about a month ago that we have been working on for a little over a year before we were actually able to close it, because there was back and forth, but we were consistent with it and we were able to work with the sellers and finding a good solution between all of us. And so it's just looking at how do you be a little bit more creative with your deals, to make or to see if the deals would work or not, and make it like a win-win situation for not just the buyers, but also the sellers and all the parties involved too. But the deal flow has definitely been a lot slower. But you just need to look and start to evaluate more and more deals and just overturn as many as you can. It becomes a numbers game at this point.
For sure. Yeah. Aileen, where can people find out more about you? How can they reach out if they want to be on your list for future opportunities that you'll have?
Sure. So we have our on our website, bonavestcapital.com/checklist. There is a video series and a due diligence checklist for passive investors in multifamily syndications that they can go ahead and download, and that will automatically add you to our list. You'll get that free resource as well, so you can take a look at it. But of course, if you want to email directly, I'm at Aileen, AILEEN, at bonavestcapital.com.
Great. All right. Well, I got two more questions for you if you have enough time. I want to be respectful. I know we're running a little long here. But with your investment experience, if you had somebody that was maybe just starting their investment career, what advice could you provide them?
I think it kind of goes hand in hand because it goes back to the education and getting that foundation and trying to build up that knowledge base as much as you can. But at the same time, once you get to a level where you feel comfortable and you understand the model, you need to take action, because knowledge without action just leaves you nowhere. It kind of gets you stuck, and you can just get into this analysis paralysis mode. So build an education base up to a certain level. And then the next step is, you need to take action and jump in and get in the game.
Yeah, I agree completely. You can only learn so much in advance, and you can kind of get just stuck in there in the analysis paralysis side. So, what about last question? I guess would be just a book recommendation, something that you read recently that you found powerful.
I really enjoy the Who Not How book by Dan Sullivan.
Me too, yeah.
And that one there, it really changes your perspective and the way that you look at, not just life, but in business as well. And so I would highly recommend that if people haven't heard of it or haven't read it yet.
Great. Yeah, I love that one as well. I love all their series of books that they've done together. So, Aileen, I really appreciate your time today. I think you added a tremendous amount of value to our listeners, and just really appreciate you taking some of your day to spend with us here.
Thank you so much, Keith. I appreciate it.
All right, thanks.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.